All right, it's 7:02. Without further ado, let's get started on today's topic. A pretty interesting blueprint for financial wellness. Today, this session will be covered by myself, Jared, from the digital sales team, as well as Summer from the digital wealth manager, all the way from Hong Kong. Very privileged to be here sharing on this topic with all of you today. Thank you for joining, and I hope this session will bring you guys a greater insight about financial wellness and what are some of these challenges faced by affluent individuals today. On somewhere in your screen, be it mobile or browser, you should be able to post some questions to the panelists, myself and Summer, so that we can run through them. Perhaps towards the end of the session, a small Q&A where we can address some of these questions. So feel free to write them down or any topics along the way. Feel free to let us know. The agenda for today, what is financial wellness and why it matters, covered by myself, broken into two parts. The later portion will be covered by Summer, the top wealth challenges faced by affluent individuals today. A little disclaimer, this presentation is brought to you by Saxo Markets, really for your general knowledge and information only. Does not constitute to any financial or investment advice. Any opinions here today are subject to change and may be personal. So first of all, why even bother about financial well-being? Many a times we talk about mental. Let me use this laser pointer. Many a times we talk about mental health as well as physical health, right? And financial health, on the other hand, is often overlooked. So it is in fact the third leg to our wellness structure that is equally, or if not more important. So we designed this chart to really show that they are all intertwined together and can't do or perform without each other. So how do we achieve financial wellness, or how do we have a positive, healthy uh, financial wellness? Okay, so to me personally, there are four aspects to it. Um, Number one, managing your bills and expenses well, pay off your debts, of course, have emergency funds to weather unexpected emergencies. And lastly, but more importantly, plan to reach your goals. So if every level of these four aspects are covered, I would say you're more or less set, considered healthy financially. I'll dive deeper. So this is a survey by PwC. These numbers to me are not shocking, pretty much expected. 57% of the people are stressed about their financial future, and almost half of them says that money negatively impacts their mental health. So especially in Asia after COVID, we have witnessed many who are under financial stress transitioned themselves into other issues or physical symptoms such as increased anxiety, insomnia, migraines, and affecting their immune system and much more. So let me start off with financial difficulty. Okay, as you can see, transitioned financial difficulty can cause stress and anxiety. Okay, and it then gives mental health problems, which makes it harder to earn and manage their money and spending it wisely, and ultimately having to ask for help. Okay, and it turns into a vicious cycle. So with this, we can conclude that financial difficulty is really a trigger point to physical and mental illness. This point, I want to highlight that financial wellness, however, the meaning of this financial wellness is different for different groups of people. Okay, we all have different needs. Take into example of someone who have just graduated in comparison with someone who is at the peak of their career. Definitely different. For graduates, some of the question that I will ask myself if I'm a graduate, how can I avoid financial pitfalls? Okay, how can I reduce negative financial situation? Whereas for the for the ones who are at the peak of their career, considered affluent individuals, how can I make my money reach new heights? How can I multiply my funds in a safe manner? This one will be covered by Summer later on, so do stay tuned. So G.I. Joe is a popular cartoon in the 80s, and the show always ends off with knowing is half the battle. So this G.I. Joe fallacy is discovered or created by some professor. In short, it's a cognitive bias that knowing is good enough. So in reality, most of us do know what to do and do know what to do to achieve something that we desire. However, we are not actually doing it. What I believe or what should be done is taking action. And this is probably the most important takeaway that we all should have today. So in order to take action, definitely we have to have a clear reason, right? In addition to this GI Joe fallacy, there's this author and speaker, Simon Sinek, which talks about the golden circle in a pretty popular TED talk, over more than 10 million views on YouTube, pretty long ago, I think 9 to 10 years ago, where it explains that we all, in fact, know what to do, how to achieve something, how to do, knows what to do, how to do it to really achieve our end result or our goal. However, most of us are not driven and motivated to do it. The reason being because we do not have a strong why. Okay. For example, right? Take into example if your goal is to lose weight, okay, and the reason is I just want to lose weight to look good, to have six packs, to be visually more appealing, okay. There is a why, but it isn't strong enough. Okay, compared to you visiting a doctor and a doctor mentioning to you that if you don't lose weight, you will probably die next year. Okay, so with this, in comparison, which one would motivate you to lose weight further? So we should all have our own very strong why to do something, right? How many of us actually share about our finances with our other half? Okay, 78% of us, we rather share our dating history to our other half, to our girlfriend, our wife, compared to our actual financial history. Okay, talking about money is quite a sensitive and considered a taboo in Asia, which leads to a lot of divorce cases. Okay, in fact, talking about money will strengthen our relationship, and it is highly recommended by many counselors to really have a support system in place to hold each other accountable for. Some of these questions that you can ask your other half to strengthen your relationship, such as what are your long-term financial goals? Okay, how do you measure financial success? What is one thing you hope your parents did differently? Okay, how much money is enough for retirement? How much money is enough for child education, your property investment, or for leisure activities? How are we going to achieve it? What is the amount to save? What is the amount to invest? For how long? If we get into the specifics, we can fine tune with each other, build on each other's ideas to ensure that we are on the same track financially. So over here, how to better manage our money? Firstly, I would say we all should have a crystal clear outline uh, with multiple financial goals. Okay, so imagine having no goal is like being in a boat in the open ocean without any compass or without any purpose, without a fishing net. Okay, essentially what we are waiting for is waiting to be robbed by pirates, right? So we should all have some form of end goal in mind, something that is hyper specific, very clear, so that we can just do and follow through without really having the mental capacity to even think at all. Okay. Um, Same thing, just like losing weight. Okay. For example, if I have a plan in place, I just execute. I will eat three prepared meals a day. I will work out 3 times a week. I will run twice a week. I don't have to think. I will just execute according to that plan. Okay. Um, we can either use pen and paper to write this down, or we can use tools to help us outline our wealth plan. A very good tool that we have in the training platform is this Saxo Wealth Care Goal Setter, in which you can use it to illustrate how you can achieve your goals. So being crystal clear on what you do, you should be able to fill out a SMART model, which is recommended by many experts. If you're unable to fill out the SMART model, specific, measurable, attainable, relevant, and time bound, it probably means that the goal is pretty vague and we should work on it. Because if we are not smart about our goals, probably we are unable to achieve them. Some wealth building tips, more often than not, we as we earn more, our lifestyle inflate as well, and then we end up spending more. So we should always spend beneath our means. We can always use some apps to help track our monthly expenses. Tip number 2 is to make sure that you reduce your debt or clear your debt. Okay, because this should be the number one priority. It comes back to the baseline. Working, for example, if I want to lose weight again, working out 7 days a week doesn't help if I have a horrible diet. So to really clear off the debt, giving you a lot of interest extra to pay. If you're on credit card debt, you are looking at 20, 30, 40%. Make sure that you have no debts in place because no investments can cover up to 20, 30, 40% a year. So an advice or what many people are doing right now is to really go back to cash and debit, where all of these cash and numbers in your bank account are more tangible and you tend to be more mindful and spending less. Tip number 3, always have emergency fund. Always prepare for rainy days when we no longer have an income. A good guideline would be 3 to 6 months as a baseline of your expenses, so that within that 3 to 6 months, you'll be able to find a new job or look for alternative income sources. However, what we always recommend is to have far more, have 6 to 10 months. And from this over here, you can see that the survey, 55% of the general population have less than 6 months worth of emergency funds. So always have more. Tip number 4, always allocate your income and if possible, do them automatically. Set them aside. Maybe you can do a bank transfer, 50% into your bank spending account, 30% into your expenses account for entertainment, and 20% for savings and investment account. So with this, it removes the friction of really having to manually allocate into these different areas. When it's done automatically, it's set for you. Okay, those are some tips and how and why we should use investing to build our wealth. Because we all know just savings alone is never enough, right? In this day and age, it is so easy to start investing. We have so many platforms available. We have so many channels, so many kind of products you can use to invest. So we should always complement our savings with investing to reach our goals. Of course, this chart shows that when net worth is small at the beginning, okay, savings then play a huge role in growing our wealth. But as our net worth starts to increase, investing then becomes more important. So let me show you what or how the power of compounding interest is ridiculously effective. This one I used calculator.net, which you can access as well. You can scan the QR code to have this model in place. I keyed in my starting amount of investments, $20,000. And of course, for myself, I wish to retire at 60, which is 32 years in 32 years time. And at a very conservative return rate of 6% per annum, because we all know S&P 500, they give us roughly about 8% returns, but we do 6% here. Every month, I contribute $2,000. Okay, by the time I reach 60, I would have achieved an amount of $2.3 million. That's roughly about 6K a month I get to spend after I retire. And you can see that the initial amount invested, or I would say the contributed amount, is only $760,000, which is only one third of the overall value. And the remaining two thirds are done by the power of compounding, where essentially, if I leave it in the bank, I am not getting this amount at all. So this is the power of investing in the long term. We should all follow some form of investment pyramid, okay? Having core and satellite investments. Of course, the bulk of your assets should be in core investments. If we just follow through this pyramid, it's like a food pyramid as well. The insurance aspect, protection should always cover the base, followed by your savings, followed by some of these more stable bonds and diversified funds. And then towards the top is where you can have some of your satellite investments into higher yielding products to form your investment pyramid. So this is a good structure to follow if you wish to have a very generic and easy to attain investment objective. And we often focus on things that we cannot control, such as returns, right? In fact, what we would suggest is that we should place emphasis and focus on the things that we can control. Okay, for example, how much I invest, how long I invest, how risky on the assets that I wish to invest in. Okay, so these are the things that we should place focus on, so that uh, at the end of the journey, the returns, no matter what, it is based off your effort, and you'll be able to enjoy the fruits of your labor when it comes to the end of the road. Something that I would like to keep everyone's in mind is that the fees are also important, as the management fees are also important when it comes to investment. As we reach a certain milestone in our career, having good amount of savings and income, and fees that are less than 1%, in fact, are really rare in the market for funds 200K and above. Um, Many a times we do have clients who sat down with us wanting, I'm looking at least 6 to 8% returns, but do then I tell them, do bear in mind that when you are in your private banks, you are already being charged 6 to 8% in terms of fees, and that equates to zero, right? If you consider what our offerings are, it's less than 1% fee that you are being charged. Later on, maybe we can touch on this. Using that, there's a popular movie, Margin Call, where the CEO mentioned that there are only a couple of ways in which you can win. Either cheat, you be smarter, or you be the first. Okay, and it's a lot easier being the first to really win at the starting line using time as our advantage. Over here, you can take a look at how to retire as a millionaire. For age 20, contributing $329 per month. Okay, you can already become a millionaire at 65 years old. Whereas if you only start out at 45 years old, you have to contribute $2,000 a month to be a millionaire at 65. Okay, so the especially for young adults or people who are starting their career, we should always use use this time as our advantage. I put a coffee picture over here to really illustrate the power of compounding effect, as well as starting off small. You see, a coffee a day over here, in, let's say, Starbucks Coffee Bean or Arabica, easily costs about $7. So just imagine drinking one less coffee a day. If you're a coffee addict, then probably you won't be heeding this advice. But just imagine one less coffee a day, that's $7 a day for 30 days, $210 a month. And then you just use this $210 to put it into the markets at 6% returns, conservative returns for 10 years. Guess how much you'll be achieving? 10K, 20K. In fact, you'll be achieving $34,000 worth. Okay, and this $34,000 is more than enough to down pay a regular car, or even perhaps support your children's education. So this is a summary of what we have learned today. And I will pass on the remaining time to my colleague, Summer, to cover on the top challenges faced by affluent individuals today.
Hello, everyone. Welcome to today's session. And this is Summer. And so nice to meet you online. A brief introduction about myself. I have working in the financial industry for around 10 years from now and served both individual clients as well as the institutional clients. I joined Saxo 2 years ago and now actually going to relocate to Singapore office very soon in August. So looking forward to seeing you in person. Uh, and also for today's sharing, actually, this is the first time I touch on the wealth management topic. So the content will be a little bit one-on-one today. But if you have any feedbacks or questions, you can just leave it to the questions, then we can pick up later. And also, before I start my presentations, I also want to learn more about you. If you have any challenges, like when you manage your wealth by yourself, would you mind sharing with us in the question channel so that we could review a little bit after? So today I'm going to cover the top three wealth challenges by the affluent individuals we have seen before. So part of the content today is come from the real client profiles, and I hope that can be inspirational and also helpful to you. Okay. So before I start talking about the challenges, just want to give a very quick recap of the market for now. So in the past year, actually for the both equity market as well as the bond market, the performance really not good, especially the correlation between the equity and the bonds stay positive, which means that we cannot effectively diversify the risk for our portfolios. And for this year, actually, the market rebound really quick. The equity market rallied recently. For example, the S&P 500 has up around 20%, and the Nasdaq is like around 77%. So, which is quite encouraging for us to invest in it. While based on the Saxo's house whale, the bubble is foaming because the fundamental is not there yet. The interest rate will continue to stay higher or even higher. Like I heard they're gonna be 25 basis point added to the interest rate in the end of this month. And also, if we see U.S. recessions in the second half year, based on the house will be fortunately unlikely to be a very deep one. And also for the US equities that I believe most of the Saxo clients are holding now, we feel the risk premium actually dropped for now, especially for the semiconductor sector or the technology sectors. The PE ratios stay really high. For example, the semiconductor stocks, the PE ratios as high as 46, almost back to the level the early 2021. So actually we should bear in mind. And also the bond, especially the short duration bond performance really good, which can provide pretty decent yield. And also we can also write on the interest rate by putting cash into the fixed deposit. Okay. After that, we're gonna cover top three challenges we see among the affluent individuals. The first one we see is like the client holding too much cash in their portfolios, which earning little or no interest for them. And this actually based on a real client sharing. The clients quite open up to us and list all the portfolios he have for now. It's around 500K US dollar as the total investable assets, but actually over half of the assets sitting in the saving accounts, uh, like earning nothing for the client. So very simple suggestion we made to the clients. Actually, he can move the cash to either time deposit or like other brokers who offer the interest rate to them, and which can easily earn them like around 3 or 4% for this amount of cash. So I think that is a very simple step, but also a very effective one because it's almost risk-free money for the clients. So if you're holding like the over at least not as much as 50%, but if you're holding too much cash, definitely you should consider like relocate this portion of money to other like interest earning accounts. So here's some follow-up actions we suggested today. If you feel interest to, like if you want to review your current investment plan and also to achieve the financial wellness as soon as possible, the first one is like, please revisit your cash positions and try to maximize its earning potentials. Not a advertisement yet, but actually, if you're not aware, Saxo is currently offering interest rate to our cash accounts. It quite depends on the amount size and also the accounts you're in. But please feel free to check via the website, Saxo website. And beyond the interest rate, I think it also provide the convenience. Like if you see any market opportunities, definitely you do not need to transfer your funds from the bank, and then you could just quickly invest it into the market. The second challenge is that the clients may be a little bit too concentrated in equity assets, and sometimes even concentrated in the regional countries like US. So here is two examples like why you should diversify a bit. For example, as you can see the colorful chart here, there's no asset class going to win every year among the past 15 years. For example, for the last year, actually cash is the king. It's the only asset class which has the positive return. No matter you invest in bonds or equities, the result will be like money bleeding. But for the past years, like sometimes the rates win, sometimes small cap win, sometimes for example, this year, the large cap outperform. But if we do not have a clear mind about the which asset class gonna outperform the market, actually the asset management, the diversification can help us a little bit. As you can see, the gray blocks here with a double A, it means the diversified portfolios like have exposure to both large cap, small cap, as well as the bond markets. It's like moderate portfolios. That could already bring us a quite decent market return. Yes. And also if another scenario here, like for example, if you have 100 to invest, there's two scenarios. Like the first scenario have a much higher returns, positive returns at the first year, and then negative at the second year. But for the scenario 2, it looks quite stable. But for scenario 1 or 2, which one you think going to have a better return? Yep. The calculation will be quite easy, but the results sometimes surprise our investor. For example, the stable returns actually provide a better end result to us. So diversification sometimes means that we can have the average market returns as well as the stable returns, which can have a better like accumulated portfolio return for us. And something that we also need to bear in mind, like before, especially in last year, the correlation between the equity and bonds are positive, which is abnormal. But this year, this situation finally flipped and is back to the normal now, which means that having exposure in the bond actually can effectively help reduce the risk of the overall investment. And also for the bond market, normally we will say cash is always preferred because cash definitely is the real risk free for us over the bonds and equities. But for now, if you're looking at the left hand, the front end of the bond market for the ultra short duration bonds that offer pretty good yield, right? Sounds very attractive, around between 5 to 5.4%. And actually, that is quite popular among the clients we talked recently because it's like short duration, comparatively higher liquidity, and also the yield is higher than the time deposit they have for now. But this also gonna change ahead as the high interest rate environment will eventually stop in the future. And so that's why, based on the House bill, we also recommend the short durations, high quality bonds for clients to consider it. And also, if you're, for example, you're now having an account with the private banking service or commercial banking services, now there's a concept about the core satellite portfolio, which means that you position the major of your investment into indexed funds or other diversified portfolios, quite rule-based, having low fees, just like Jero said, fee can be the killer of your performance, and also long-term, diversified, and stable for you. It also called sleep well money, means that once you set it, you can forget about it. And also for the satellite, you can strategically position it to have more alpha, have more return drivers, and also it can be more active managed. So no matter how the market is, the most important thing is that we should, as the investor, we should be clear about what's our risk profile. For example, what's our risk tolerance level and what's our preference. For example, if I'm as a young lady, I still have like at least 30 or 40 years to invest. So that's why I feel I can bear more risk at this moment. But for a client who may be in an elder age, who just looking forward to the retirement life, definitely the risk profile or the risk exposure in the current market should be reduced or should be properly managed. So here is another follow-up action recommend to today's audience is that please understand more about your risk profile and try to examine your current investment strategy. Is that suit your needs at this moment? Do you feel comfortable about the risk exposure at this moment? And for the challenge 3 is that our affluent clients, sometimes they're too busy or too difficult to manage all of their wealth. Here is another case shared by our clients. Yep, maybe I can check this. The client is really open up to us. That's why he lists everything he have. For example, he has the accounts among several commercial banking as well as the insurance companies, and also they're holding diversified asset class and even holding 7 currencies in the portfolios. But for him, as a very busy professional, can he manage this by himself? I don't think so. That's why he may have many advisors, but it's very difficult for him to have a bird eye to oversee all the investment himself. And also, it's hard to estimate the overall expected return for the investment. And for example, if we have a long-term goal like retirement, how could we measure is that achievable or not? So that's why we would recommend the clients examine their current investments uh, item by item, so that we could quickly identify what the improvement can be. For example, the clients are holding too many cash in Standard Chartered Hong Kong, but actually earning very little for him. That's why we would recommend to reduce the cash drags and encourage him to move the money to someplace else, like which can earn more interest rates, or invest in the bond market at this moment. Yes. So the follow-up action here for all of you today is to try to list out your investment and identify the drags. So that I think that is the first step if you want to achieve your long-term goal. The first step is to understand yourself. And if you have any questions or like concerns about the asset management solutions that Saxo can offer, and please feel free to reach out to me. I'm happy to talk to you regarding this. Yes. And I think this is the end of my deck for now, and now coming to the Q&A session.
Thanks, Summer. Thanks, Summer, for sharing some of these real life cases that you have with clients. I think those are very real examples, and in fact, there are many solutions. There's really no one solution that fits all. Many solutions that can cater to different needs, different type of clients, meeting different objectives. Okay, of course, at Saxo, we are a one-stop multi-asset trading platform, really catered to all kind of clients. We have multiple asset classes which you can access into. Of course, later on, perhaps I think there are some questions. We can try to address them first before we dive deeper into what we offer. Yeah. I think there is one question with regards to um, do I have to have a large amount of money or cash, such as like 100K, to start investing to really make it worth it? Mm.
Mm.
For this, maybe I can touch on them a little bit. In my opinion, I think the starting amount is not crucial. What is crucial is really starting out as soon as possible. Why wait? Why save up to a specific point and then to invest? Okay, unless you really need that liquidity in hand, in which you will be using that funds, then perhaps you can do that. However, if you are really saving up in a bank, earning you little to no interest, then you should start out as soon as possible. Because while saving up for this 100K, you may take a couple of years to reach them. And in that couple of years, there could be market situations where your funds could have been doubled. So we are really losing out or missing out on this opportunity to have your funds doubled, or perhaps have your funds increased significantly. The opportunity cost is what you are lacking if you are waiting to save up. So in short, my answer is no, you don't have to. You can start off with any amount, but start as soon as possible. Any take on this, Summer?
Yeah, definitely. We do not need to start from with a large amount. For example, as the coffee example you shared, actually every day if you invest small amount, actually gonna generate a great profit for you in the long term. So that's why I don't think we should stop, because we do not have the saving for now. Yeah, but and also for the management solutions, at least that Saxo currently offered, actually the minimum requirements can be as low as $2,000. So quite affordable, even you're just graduate, or actually you just work for several years. So I think that is a good start, and then you could train yourself with the investment habit, and grow the wealth steadily. Yep.
Thanks, Summer. There you go. Moving on to the next question. What do you think is an optimal asset allocation percentage
Hmm.
with regards to what is happening in the current markets? Summer.
Yes. Yeah. Actually, for now, the we see the market, like the performance quite good, especially in the technology sectors. For example, like Tesla or Apple, Alphabet, etc. Already like the Nasdaq up around 37% this year. So I feel the risk premium that we can have from the US market, especially it quite concentrated, like dominated by the large cap companies, is the risk premium is shrinking at this moment. So based on the house bill we have, the short duration bonds can be a good asset class to look into. And then, which means that if you have the market view, for now, definitely you could adjust the allocation between equity and bonds, and even part some cash with the high interest accounts.
Wow.
Yeah, yeah.
Cool, cool.
Sorry,
Thanks.
I cannot mention like the optimal one because I feel uh, the most optimal one is the one that suit you the best, suit you the most. But if you talk about the market, definitely bond market seems quite attractive at this moment.
Of course. Thanks for sharing, Summer. I think many of Saxo clients or people who are starting out their asset management journey. Maybe in the past they have invested into stock market ETFs, and then perhaps they have also speculated a bit using leverage products like CFD options futures to try to generate some profits. But neither here nor there, of course, having gained profits in certain years not so much, and maybe they are looking for is a way to really optimize and really not stress about um, their finances, have a portion of their investments or a portion of their portfolio into something that manages itself, but and also give them tailored solutions to meet all of these important milestones and goals they have in life. Which coincides with this question that we have from the audience as well. Where can I find more about Saxo's offering on asset management? Maybe Summer, you can take this.
Yeah, definitely. Um, yeah, actually, if like for the client, if you walk through our Saxo website at this moment, we have three different wealth management solutions offered at the moment with different minimum hurdles as well as suits different needs. For example, the Saxo Select is that you already have your core portfolio built and you're exploring the satellite investment. You could shop with the preset portfolios that having insights from BlackRock or Blind Globals or Nasdaq, etc. But if you want to build a quite personalized long-term investment goal, definitely WealthCare is the solutions here we offer to everyone. And hmm? if you want to learn more about the solutions we have now, you're welcomed to book a consultation session with us. Just simply input your contact info and also let us know more about your investment goals or why you're looking for wealth management solutions here. And then just we got the chance to um, dive in your current investment needs.
Sure, I think, yep, this is a pretty convenient uh, avenue where you can reach out to our subject matter expert in terms of asset management, and then definitely have a good plan for your goals in which you're looking to achieve in coming years. So it has been insightful hearing from you, Summer. I think we have also come to the end of this session. It's 7:46. So once again, thank you everyone who joined this evening's webinar. Again, honored and privileged to be on stage with Summer and sharing these experiences. And yeah, we will see each other again soon. Summer?
Yeah. Thank you for coming today. I hope the all the information we provide is helpful and hope we can see you in person soon. See you.
Yes. Take care, everyone. Thank you.
See ya. Bye bye.
Bye.